Hi. Let's learn about liquidation. Liquidation in finance and economics is the process of bringing a business to an end and distributing its assets to claimants. It usually occurs when a company is insolvent and cannot pay its obligations when they are due. As company operations end, the remaining assets are used to pay creditors and shareholders, based on the priority of their claims. General partners are subject to liquidation. Chapter 7 of the U.S. Bankruptcy Code governs liquidation proceedings. Solvent companies may also file for Chapter 7, but this is uncommon. Not all bankruptcies involve liquidation. Chapter 11 involves rehabilitating the bankrupt company and restructuring its debts. In Chapter 11 bankruptcy, the company will continue to exist after any obsolete inventory is liquidated, after underperforming branches close, and after relevant debts are restructured. Unlike when individuals file for Chapter 7 bankruptcy, business debts still exist after Chapter 11 bankruptcy. The debt will remain until the statute of limitations has expired, and as there is no longer a debtor to pay what is owed, the debt must be written off by the creditor. Assets are distributed based on the priority of various parties' claims, with a trustee appointed by the U.S. Department of Justice overseeing the process. The most senior claims belong to secured creditors who have collateral on loans to the business. These lenders will seize the collateral and sell it, often at a significant discount, due to the short time frames involved. Next in line are unsecured creditors, including bondholders, the government, and employees, if they are owed unpaid wages or other obligations. Finally, shareholders receive any remaining assets, in the unlikely event that there are any. Liquidation can also refer to the act of exiting a securities position. In the simplest terms, this means selling the position for cash. Another approach is to take an equal but opposite position in the same security, for example, by shorting the same number of shares that make up a long position in a stock. A broker may forcibly liquidate a trader's positions if the trader's portfolio has fallen below the margin requirement, or they have demonstrated a reckless approach to risk-taking. Company ABC, after 10 years of profitable operation, struggles financially due to a downturn in the economy. It becomes unable to cover any of its expenses. The decision is made to liquidate the business under Chapter 7 bankruptcy and sell off its assets, which includes a warehouse, trucks, and machinery valued at $5 million. With $3.5 million owed to creditors and $1 million to suppliers, the sale of assets will cover these obligations. Here are 5 key takeaways. 1. The term liquidation in finance and economics is the process of bringing a business to an end and distributing its assets to claimants. 2. A bankrupt business is no longer in existence once the liquidation process is complete and it has been deregistered. 3. Liquidation usually occurs during the bankruptcy process under Chapter 7. 4. Proceeds are distributed to claimants in order of priority. Creditors receive priority over shareholders. 5. Liquidation can also refer to the process of selling off inventory, usually at steep discounts. Hope this would help. Thanks for watching.